Hello, everyone. Welcome to the Trading Syndicate course on supply and demand. This series of videos is designed to teach you the ins and outs of using supply and demand in your trading. This style of analysis is incredibly powerful as it allows for low risk, high reward setups and has a relatively strong win rate. By understanding the concepts of supply and demand in terms of how they drive price movements in the market, you will be able to trade like an institution, which have win rates that are much higher than the average retail trader's win rate. Let's get right into it. Supply and demand runs all market economies, and the stock market is no different. It is driven entirely through the imbalances of supply and demand. The imbalances of supply and demand is what forces price either into the up or down direction. The greater the imbalance between supply and demand, the greater the move in price will be. By identifying supply and demand zones, traders can identify where turning points in the market are likely to occur with high accuracy. There are four basic laws of supply and demand. The first being that if demand increases and supply remains constant, then a shortage will occur and price will move higher. Likewise, if demand remains constant and supply decreases, a shortage will once again occur and price will move higher. When there is a shortage of something, more people want it than is available, which means that it can be sold for a higher price. For instance, imagine that there's a potato famine and there's a shortage of potatoes. Well, more people will want potatoes than there are available, so the people selling the potatoes will raise the price because buyers are more willing to pay a higher price for the potatoes since there is only a limited supply. The next two laws have to deal with when there is more supply than demand. If demand decreases and supply remains constant, then a surplus will occur where price will move lower. Similarly, if demand remains constant and supply increases, a surplus will once again occur and price will decrease. A great way of understanding a surplus is to think that if there is a lot of something that pretty much anyone can get their hands on relatively easily, then it will be sold for a cheaper price since it is so available. For instance, if suppliers now have tons and tons of potatoes, where there are more potatoes than are needed by consumers, then suppliers will drop the price of these potatoes since they need to get rid of them very quickly before they go bad. And the best way to get rid of them and sell them to consumers is by dropping the price. If the sellers do not drop the price, they will sell far less and have more potatoes than they can sell, causing them to actually lose money. In the market, supply can be thought of as sellers and demand can be thought of as buyers. Imbalances between sellers and buyers will drive the price either upward or downward. If there is more supply than demand, where there are more sellers than buyers, then price will decrease. Likewise, if there is more demand than supply, where there are more buyers than sellers, then price will increase. These imbalances cause price to move. And when price is balanced, this means that there are equivalent buyers and sellers, so price will not move. You only really want to trade when there are imbalances, as this is when price will be moving upward or downward. Now, you may be wondering where these imbalances come from. Well, they actually occur due to institutions. Institutions are firms that manage large sums of money, such as hedge funds, banks, investment firms, and so on. Pretty much any large company that trades large amounts of money can be considered an institution. Now, institutions differ from you and I as we are considered retail traders, where we trade our own money and on a much smaller scale than institutions do. The more money that is used in the market causes larger market moves. Since institutions are trading with large sums of money, they cause far greater movements than retail traders do. We can use supply and demand to identify where institutions are buying and selling. For every buyer, there is a seller, and for every seller, there is a buyer. One cannot coexist without the other. So what this means for the market is that large institutions cannot enter nor exit full positions all at once without moving the price too drastically from the price that they are comfortable with entering or exiting at. For instance, say if a firm wants to sell $1 billion worth of stock at a specific price, well, they would need $1 billion worth of buyers to buy the stock from them at that specific price. Due to the fact that it is unlikely that there are just $1 billion worth of buyers who are eager to get in at that specific price, this causes an imbalance between supply and demand. To get around this, institutions will leverage their position where they will set multiple small limit orders to fill at that price over time. So when there are buyers who are purchasing at that price, those limit orders will fill. Now, this will generally push the price of the stock back downward, and the rest of those limit orders will only fill when price re-enters that level. This is how a supply or demand zone is created. When price does return to that level, it is retail traders who are filling the institutional orders, driving the price back downward. This would be an example of a supply zone. So it is retail traders who are basically providing profits for the institutions. They are the ones who are creating the liquidity for the institutions to fill their limit orders. We do not want to be thinking like conventional retail traders who are buying where the institutions are selling. We want to trade with the institutions, not against them, as retail traders are providing that liquidity for institutions to buy or sell their positions. Let's take a quick look at a supply zone on this chart here to get a better understanding of this concept. On this red candlestick here, an institution put in a leveraged position where they set many limit orders to sell the stock at this price. As you can see, from the initial orders that were immediately filled, the price of the stock shot downward since there was an imbalance between supply and demand, where there were more sell orders than buy orders at this level. However, since only some of the orders were filled, the rest of the orders remained unfilled and will fill when price retests this zone. When price comes back to re-enter this zone, a retail trader may be entering a long position prematurely and thus creating liquidity for the institutional orders to fill. Once again, those orders were then filled and price shot immediately back downward as there was still an imbalance between supply and demand, where there is more supply than there is demand. We do not want to trade like those retail traders and rather trade like the institutions who are shorting at this level. If you did not know that there was a supply zone here, you may have gone long on a position and may have lost money. Now, throughout this course, we will teach you how to identify these zones and how to play them as well, so do not worry if you are feeling a bit lost right now. But anyway, when price comes back to this level again, the orders that remained waiting to be filled were filled and price shot back downward. As you can see, this supply zone was the force that drove price back downward. Now taking a look at this demand zone on this chart here, on this green candlestick, an institution put in a leveraged position where they set many limit orders to buy the stock at this price. Once again, the initial orders that were immediately filled shot the price of the stock back upward since there was an imbalance between supply and demand. This time, there were more buyers than sellers at this level. Being that not all the orders were filled, the rest of the limit orders remain there unfilled until price returns to this level where they are quickly filled by retailers looking to short the stock at this level, which created the liquidity needed for institutional traders to fill their orders. This shot the price back up as many buy orders were filling here, and retail traders who shorted at this price were losing money fast. Again, you do not want to be one of those retail traders who are shorting here, and rather you want to trade like an institution in order to profit on a trade here. We'll touch up on everything you need to know about these levels as you progress through this course, but in this video, we just went over the basics of supply and demand. Anyway, our goal with this course is to teach you how to identify and trade these zones like an institution. Remember, as Warren Buffett once put it, the stock market is the device which transfers money from the impatient to the patient. So stick around and learn more about supply and demand zones by progressing through these videos.